I'd like to welcome everyone to the Greater Central Florida Multifamily Investors Meet, where we invest where it makes sense. And I'm your host, Ismael Reyes. And the purpose here is to get in touch with each other, network, do deals together, bring investors that maybe are looking to, they don't really want to get into this business, but they like to invest and they want to make some money that way. So there's a lot of different folks here, whether you live here in the area or whether you're in California, like I have some people that have joined us before. It's just good to get a group of folks that are focused on a particular area.
Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense.
Today is all about, okay, we had Hurricane Ian, it came through, it hit a certain area of Florida. Thank goodness that it didn't hit Tampa direct and it went a little bit south, but the Gulf Coast, along the coast, there's a lot of population there as well. So it's not like I completely missed. So it'll be interesting to go into this and see, what I believe this means, and then go from there as we continue. You'll see why, to look for good deals here in Florida and certainly in Orlando. So let me go ahead and get the presentation started here. All right, can you guys see that?
Yes.
Yes, sir.
All right, good.
Yes.
Hey, how you doing, man?
How are you?
I'm good. Hey, keep me honest today, all right? I know you're an expert at this too.
I will.
All right, perfect. All right, so, and let me make sure I got my camera on right. So when this thing records, it actually records what I believe is the recording. Right. I think that does it. I think we are ready to go, and let's jump into it. How is post-Hurricane Ian for Central Florida housing and, sort of it from an investor standpoint? How is that going to work out? We know what happens. People kind of stop and, they look around and they're not sure what to do. And unfortunately, this is actually some of the best times to invest in real estate. But there's a lot of dynamics. So let's jump in. A little disclaimer, this is for information purposes only. I don't want anybody to go out here and, based off of this alone and go buy some mansion somewhere in Orlando and say, hey, Ray, you told me to buy this thing. Everywhere that we buy, you have to buy right. Clearly, we want, there's certain areas that are just better to invest, but you also have to go through the parts, to the underwriting, to the analysis, to make sure you're buying right, because that's really your biggest I guess, thing that you have going for you at the very beginning. If you buy right, a lot of things can go wrong and you'll still be okay. If you buy wrong, a lot of things can go right and it'll still not be too good. So leave it there. Here's the outline. I'm gonna tell you a little bit about the bottom line up front, about what I think is happening. Talk a little bit about the fundamentals. I think the fundamentals really set the conditions for everything else that's going on. And then when we go into some of what happened in some of the other hurricanes, the fundamentals played a part in what happened post-hurricane. So I think it's important to at least address that and have everyone kind of get up to speed of where I believe we are from a fundamental standpoint here in Central Florida. We'll talk a little bit about what the Fed's got going on, what they're doing, and how that's impacting things. We're going to see supply is a continuing topic, or I guess the deficit, the lack of supply is definitely something to touch on. And then we'll jump into some of the hurricane effects and use some of that. Sometimes it's a little bit more analytical research type information. Sometimes it's anecdotal. But I think at the end of the day, I think it does give a good feel for what I believe is going to happen based on those events. And so we'll go into that and then kind of finish up and go into a little bit about, okay, so now that we've talked about all this stuff, if you haven't asked questions, and that's going to be a great time to do it. But I encourage everyone to ask questions as we go through. This is more of a discussion and not just me going on and on and on. So here we go. Bottom line up front, I think Central Florida has a lot going for it. It has attractive fundamentals and a significant housing supply shortage. That coupled with rising insurance rates and increased construction costs, both from higher replacement costs and improved and more resilient housing, which is something that always happens post-hurricane, it seems like, will continue to push home prices higher. And when home prices go higher, we know what happened. Less people can buy homes, more people end up having to rent. That's just the reality, right? Good, bad, or indifferent, we provide something that people need. Housing is not something that we want, it's something that we need. So it's great to invest in that because, you can not have a drink of, a Starbucks coffee perhaps or something else, but you will need to live somewhere. What Hurricane Ian's going to do, it's going to create additional pricing pressure on Central Florida in the short term. And we've seen that, play out in other markets, and we'll go into that. All right, so let's talk a little about the fundamentals. I think that's going to be an important, as I mentioned, an important thing to kind of have the conditions for. People keep coming to Florida. They just do for a lot of reasons. And the estimations that I've seen are anywhere from 20 to 25,000 new housing units needed per year for the next decade. There's multiple reports on this. I've got one there. There are others that you can just do a quick search, and it's just nothing new. It's just important to emphasize that point. And we'll talk about why right now, because it's not just about people. It's about the money that people bring here. Take a look at these charts here. What the top chart tells you is that wealth migration, the domestic wealth migration coming into Florida, brought another $23.7 billion to the state. That's money that is being used within the state from other places. And if you take a look at the bottom chart, those are some of the big ones where people are coming from. We get a lot of people from New York. We've actually seen a lot more people from California, although a lot of them do look at Texas. There's a lot of them that are looking here in Florida as well. It's just a lot of money coming into the state. And when people come, the money is, these people are either retirees that already have fixed incomes and they have money, a lot of them do, or they may be, even college students that are coming to the university and then they stay here. There's a lot of technical jobs, both in Orlando and Tampa. There's a lot of digital work and for these millennials. And so you continue to have an influx of people. It provides an influx of money, and you can clearly see that in when you talk about some of the GDPs. And so this chart goes back all the way to 2002. Yeah, these gray bars here are essentially recessionary periods. And here in this area here, this is kind of the COVID effect that we had, right? Right around 2019, 2020. And what happened here in Orlando, we had a decline. Clearly, I think most places in the country had a decline because of COVID, probably globally. But as you look at the trend here, obviously we went into this recessionary period, but it's been a generally upwards trend. And that's what we want to see when we start looking at data. We want to look at data. We want to go at least 5 years and take a look at what the general trend line is. Now, if we look at this thing next year, and that thing is still pointing downward, we need to relook. I think obviously the COVID effect's going to kind of tail on for a while, but at the same time, I think what we'll see with some of these follow-on slides that it's kind of gone away for the most part. It's done. Here's Tampa. Tampa, same thing, same general trend here. Tampa had a little bit less of a COVID effect overall because it had a little bit more diversity in its employment and in its economy. Obviously, Orlando, you have a lot more, almost 18% is more tourism. And so with COVID, that was clearly something that impacted the tourism here. But it quickly rebounded, as we'll see. Talk a little bit about the state of Florida overall. We're 2% unemployment as of this chart here, which is August of this year. We're doing pretty good as a state. And I think, again, when the state does well, it kind of goes and it goes all the way down into the metro areas. And we're seeing that here. Most of the metros in Florida have done pretty well. When we go dig a little deeper now, we talk about jobs itself and unemployment. Again, we're looking at trends here. We're not trying to track, one specific thing, but when you do see an anomaly in a chart, we want to address it. Again, here's here's COVID. Here's the COVID effect of both Orlando and Tampa. Again, Tampa had a little bit less of an unemployment uptick because of it, a little bit more diversified economy. But at the end of the day, if you look here at Orlando, it really, unemployment shot down very quickly, much more quickly than Tampa did. And I think Tampa, between the two markets, if you looked, actually Orlando is actually still trending a little bit downward on their unemployment. And even though it's still a little bit higher than Tampa, it's still trending downward from July to August here that you see, whereas Tampa, it's pretty much flattened. We'll have to see as that curve kind of continues. But if you look at the overall trend, just the unemployment for this area has been very good for a long time. So the next thing we want to look at, we've talked, when you talk big three, you got people, money, jobs. Follow the people, follow the money, follow the jobs. That gets you to at least a good baseline for places that are worthwhile from an real estate investment standpoint. Then we take a look at the risk. And the first risk that we have to subtract from, as we're looking at these, is political. What is the political risk? And when I talk about political risk in this chart, this is a chart that's done by the Tax Institute every year. And they talk about, what are the Tax Foundation every year. And what they talk about is they rank the different states based on their tax climate and their business climate in a more general sense. And you see Florida continues to do very well there. I was kind of surprised that Texas didn't do quite as well, even though it's 14, it's still pretty good, but that Florida is doing so much better. So it's a good trend. It's not that I discount Texas at all. Another great investment location, but certainly from this slide, I think most people would at least in the short term have focused on Florida a little bit more. This is a real busy slide. I won't go into all the details. It's a good chart that I got from Yardi. And what I do want to focus on is, when they talk about political risk, they're talking about three different things. We already talked about tax burden and pension liability, which is why both cities or metros in Florida and Central Florida are doing very well there. But when you kind of look into a little bit of the rankings between Tampa and Orlando, Tampa's got a little bit more, more of a risk involved with some of these other things, certainly urban policing and security, and if you look down here, how they come up with that essentially is crime per 100,000. Orlando's just doing a lot better from a crime perspective overall between the two markets. And then as far as philosophy towards affordability, we'll have to take a look at this. I think part of why Tampa's a little bit lower there than Orlando is frankly because it doesn't have any space to build out. You've got the coast, it's kind of stuck. You really can go down a little bit, down the coast or up the coast, but you really don't have, like Orlando does, a lot of room to grow. I mean, although I guess if Tampa keeps growing and Orlando keeps growing, essentially it's going to be one huge urban center. So I think overall, I think both are well, but certainly based on this assessment, and the link is there, this I think behind a paywall, but it's very good analysis there. So it's good to just kind of highlight. And I guess before I go that, obviously, when you talk crime, you want to really drill down a little bit further than just metro, right? Yeah, that's a good start. You really got to need to look at that submarket and even that neighborhood when you make an assessment on what the risk is there. You can't just rely on a chart like this to get you to the best places to invest. You got to really drill down. So that's your big 3 minus R. That's really the fundamentals that I use when I look at properties, and I always ask these questions. And sometimes, as we're going through our analysis, I may forget initially because I think it's one way or I think it's another, but I always go back before we commit investor dollars or my money to look at these. And it's critical that everyone does and not just assume that things are going well and assume these things because they do change over time. Let's change a little bit now and talk about some of the other things that are going on right now. Obviously, the Fed is really doing a number on a lot of things, right? They're really trying to stifle this chronic inflation. And sometimes inflation, it's almost like it's a self-fulfilling prophecy. You think there's inflation, and it keeps going. So I think that was part of why the Fed last year was trying to convince people that inflation was temporary. we all knew that it wasn't temporary. We knew that there was a lot of supply issues related to that. There were a lot of other things going on. But if you all remember, I think we even discussed it on the show, the Fed kept saying no, and the government kept saying, no, that's a temporary thing. We're going to rebound. The reality is, I think they were just trying to do everything they could to kind of change that dynamic. But it got to the point where they really couldn't. But nobody in this crowd that's here should be surprised. We knew that. We knew that, that this was going to happen, that inflation was going to happen. And we did our analysis. And when we started looking at properties, yes, we were going higher than 3%, but no, we didn't, in the out years, we didn't continue to project, 6, 7, or 8% rent growth, right? We didn't do that. It doesn't make any sense. So I think most people that, have listened, they kind of know where we are in the cycle and what's happening. But essentially, we're at 3.25% right now. The next meeting is, a Fed meeting is in November. More than likely, we're looking at a 75 basis point, 50 to 75, but probably 75 basis point kick up there. So to get us at 4%. And what that really means, and we'll see on the next slide, the probability of a soft landing, just like the probability that this thing was temporary, is just not going to happen. I think at this point, soft landing is just going to be very hard to do. Turning these things around, when you start trying to figure out how can you lower employment, or I guess raise unemployment, which is one of the things they're trying to do because labor has gotten so expensive. It's just not something you can do so quickly. And I think at this point, they're probably going to overshoot. And one of the ways that we can kind of see that, even though we know that they're going to continue to raise at least for the next few meetings and possibly into next year. What we look at this slide here, this is an inflation slide that is smoothed out. It's a 3-month smooth average for inflation. And as you can see here, obviously when you have 1 month to another, you got a lot of jagged little, ups and downs as you're going through and trying to figure out what's happening based on the Fed doing what they're doing. But essentially, if you smooth that out, you smooth out the edges, you'll see that in the last 3 months, we really are getting close to where we need to be, that 2% in this chart. But if you saw some of the reporting that was coming out even as late as a couple of days ago, there was the biggest thing is that inflation went up by 0.4% last month. Again, these things kind of go up and down a little bit. It's more about a trend, but I think until that trend has been going down for several months, I think we're going to be in this kind of this upward trajectory for the Fed. And as I mentioned before, we knew this. I mean, we knew as this relates to rents and our business and investors, we knew that this was going to happen. We're going to have, a very good year over year for the last year, and even this year, and even into next year, perhaps. But the thought that you're going to have 10% rental raises over that time, it just doesn't make sense. And nobody should be projecting on their analysis a property doing that. Yeah, because there's a lot of injects going on to really put the kibosh on that. But having said that, we still have, regardless of what the Fed's doing, we still have a major supply deficit in housing. And I talked a little bit about that. We really need significant housing construction, significant properties, affordabilities, and you'll see that affordability actually becomes harder to achieve going forward, but it's already a problem. And it's going to get worse. According to this report, for the next 12 to 18 months, it's going to continue to get worse. We're not going to have the type of supply being built that we need. One part of it is because you have to go and fix some of the stuff that's kind of been torn down because of the hurricane. And there's other reasons that we'll go into. But even if we could deliver, here's an interesting quote here. Even if we could deliver 6,000 units right now in downtown Orlando, they would all be absorbed. This is a report out of the Orlando Business Journal a few days ago. And I've actually been looking at some properties in downtown Orlando area, and every place I go to basically we're doing comps of the competition to see what's going on in the market, how many vacancies, what are the rents, and this sort of thing, because you can't always rely on on people reporting the right information. Sometimes you got to be a secret shopper, And that's part of what we do as active investors. And just about every place I went to, they were 100% full. They were 100%, there was no occupancy at all. And I think that's what we're seeing, right? And then when you start throwing in, we'll talk a little bit about the effects of the hurricane, that's not making things better. Here's another thing that I think is important for people to kind of get a sense of, because builders, builders are in to make money. I mean, let's face it, they're not going to do this for free. Their costs are going up, and really, there's the sentiment for how they feel the business is going for them is the lowest that it's been since 2011, if you don't include COVID. Their labor is going up. Those are on the active side of this. We know how hard it is to sometimes find people we need to do the work that we need done. Materials still haven't quite caught up with the supply issues that we've had, global supply chain and all these other issues related to supply, although it is lessening, we still have some issues there. And then the interest rates are going up. And guess what? When a builder is building, they have to take out a construction loan in many cases while they build that property. So they're also having to deal with higher costs associated with their business. So all that means is, they're just not going to build. I mean, we're not doing spec homes anymore, really. There's some build to rent products out there that are being done, but these are projects for the most part that somebody's buying and that they're being constructed because they're buying. It's not a lot of spec homes as we had in the last recessionary period, the big one, 2008 to 7 and 8, where they were just building it, and they just, you knew that the minute it was built, somebody was going to buy it and buy it for more. Well, that's not where we're at, and we haven't been there for a long time. Let's talk a little bit about insurance. I think this is where it got really difficult when I was trying to put this together for y'all, is that insurance, we know it's going to go up, and it has been going up for a long time here. Florida is kind of one of the places where we have the highest levels of insurance in the nation. So, we do have higher insurance, and part of that is not because of the claims. I found out I was doing some more reading. It's because there's Florida. There's been a lot of litigation that happens from previous storms, and a lot of it is it's the kind of litigation that really just people trying to get over. And in fact, I've already seen some anecdotal evidence. You have some people now that are going around knocking on people's doors in some of the affected areas, asking hey, how can I help you? With your claim. And then they get involved and they start doing litigation. And they actually, the ones that make the most money on this is the lawyers as they're going back and forth. I mean, really, the people that are trying to, work through this and do this right don't make a lot of money on it. Maybe they get something replaced, but most of the cost associated with, insurance going the way it's going is because of all the litigation from previous events. That's something that I didn't know, but is obviously impacting. And I did see some discussions from the government, the state government, talking about that, how that needs to be addressed, because that really is one of the biggest issues. But I guess in more general terms, if you see some of the reporting here, some people think it's all over. Everything's just going to go nuts. Insurance, this broke the camel's back, but now you've got a little bit more recent information. These are just in the last couple of days, where two of the largest groups that have property insurance in the state of Florida are saying, we think we've got this, and we've got this because there's been less claims, and because we have been, the rates have gone up significantly over time just for this type of event. So I think that's hopefully good news, but there's more to be done here. And when I've talked to some insurance people recently about, as we're looking at acquiring some assets and what they think, I think it's going to depend really on where. Obviously, some of the coastal areas will see more, significant insurance, I guess going up, and also some of the gyrations where you're not quite sure. Inland, I think. Obviously, we had flooding inland. Everything here is a peninsula, so we're still going to get the effects of rain and water. But I think it's going to be based a lot more on the type of construction, and we're going to see how that plays out. Construction and construction materials, how that plays out in pricing, because I think it's important. So let's talk a little bit about just now going and really talking about some of the historical things that have gone on. I kind of cued in on Katrina and Harvey because they were the two costliest hurricanes, and I didn't want to spend a ton of time going and looking at every hurricane we've had. Essentially, from this chart over to the right, as you can see, there's in each of these hurricanes, there's been a bump up in pricing after, and that just makes sense, because what you have is essentially you have less people or less housing available in areas that were affected. So and not everybody leaves in these areas. They may move a little bit inland, or they may wait until there's construction, the construction to rebuild, and they can go back to living their lives. People don't just move like you think, okay, well, it was a hurricane, everyone's gone. If that were the case, Florida wouldn't be where it is today. These people just stay, and but what does happen is you do have some additional costs that have to be, that bear out for people that want to live here. Let's talk a little bit about Katrina. Again, saw a short-term sales price spike. They did see increased insurance costs. Part of that, obviously, from what was going on, trying to factor that in and build that into future insurance. So they did see some of that. It wasn't outrageous, at least for Katrina, as far as insurance costs go. Where they saw a significant, and it kind of ties into the price, not just short term but long term, is that after Katrina, they did some studies and they realized, okay, well, obviously part of what happened in Katrina is, again, a lot of flooding. And so, so if you kind of apply that same sort of scenario to Florida, what they did is they changed their standards in some of the areas where they did not figure it to be part of the floodplain area. And they changed the standard and kind of added some areas, and then changed the codes so that when you build anew, you have to build 2 feet higher. So that part of that code alone raised the prices significantly on new construction. And if you didn't have new construction, if it was a property that did not, because if it wasn't destroyed and it was just fixed, you're not going to destroy it. But essentially now you have to bear the cost of now being in that flood zone and not having that height that the newer homes have. And what we've seen here in Florida, what some of the anecdotal stuff that I've seen even from the recent hurricane, is there were areas that were built essentially after Andrew came through with much higher building codes that just did much better during the storm, because the codes were built, were designed to be able to withstand higher level storms. What that means is a cost associated with that, right? Because you start building, you start adding better material, thicker material, whatever it is that you're doing, you're adding additional costs. So that's going to drive your pricing of housing, but it also improves your housing stock. It's just, unfortunately, for those that were having affordability issues, it does make it even harder, because prices are going to continue to go up. What else here? I guess the other thing about Katrina that was interesting is that the Fed funds rate is pretty similar, actually a little bit higher than where we are right now. And if you look at this, just anecdotal here, one of the reporting, the Fed did not, blink. They were on this trend of just kind of going up and up and up, although they were doing 25 basis point injects for about 11 consecutive periods. It wasn't like it is now where we're having 50 and 75, but nevertheless, they continued to increase the rate over time, and they did not stop because of that. So I don't believe that that's going to be the case this time either. I think the Fed is going to continue to drive on. They're not even going to hesitate with what's going on here as far as trying to slow down what they're doing overall, because I think the overall economy and the inflation is a much bigger concern than what is going on just in the state of Florida. So when we look at Harvey obviously was the most recent huge one, which obviously this was did I get this right? Let me make sure I got this right. So Katrina. Okay, so Katrina did not have the issue. So I got to add them backwards. So Katrina did not have the issue with raising of the housing, but they did have significantly stronger building codes that were done post Katrina. So it wasn't that specific code, but they still went through a process to address what were some of the shortfalls in some of their building. and they bumped the codes up. Now, this was Louisiana. Louisiana did a good job there, but apparently Mississippi and some of the other states that were affected in the Gulf have not, and they have, partly because they have more affordability issues. They have not embraced some of these new codes, so those areas are still very susceptible to storms in the sense that they have not. They haven't been improved. The area hasn't been improved. So new construction may or may not have these new codes. So that may be a significant thing if you're looking in those Gulf areas, that they have not looked to improve some of their building. So now obviously in Harvey, that was the huge thing. It was the flooding. And so in Harvey, we did have that happen as well, as far as the codes costing people a lot more money. You see here anywhere from 11 to 32,000, depending on how big the property that somebody was trying to build and the elevation that it started at. And so significant there. So I think that's the one key what we continue to see, and I really didn't address this in the other one, but occupancy, and we're going to see something that we're going to see here in Florida is, and we already have very tight occupancy. We're going to see even tighter occupancy going forward, because there's just a lot of folks that are looking for temporary places to stay. So they're going to rent, maybe some short-term rentals, some maybe even staying in some hotels while they rebuild. A lot of them will rebuild. It's just going to take time, but what that means is you have less stock. So what you have people where you're already having supply issues. Now that's become even worse. But one thing about Harvey that was interesting is his first point here is Harvey, the fundamentals for Houston were not going very well for them. They were, essentially they had just gone and overbuilt. There was this period of time there where fracking was huge, and you had a lot of influx of people coming in. Houston is really, I guess they rely a lot for their economy on oil, and so fracking kind of didn't do what it needed to do from a housing standpoint and economy standpoint, and they overbuilt. And what Harvey did was it actually, essentially their absorption period went from what everyone thought was going to take about 18 months to kind of get back to the point where you had some equilibrium in the market there, to essentially going up right away for the same reasons. You had a lot less, where you had extra apartments and extra space. Now you had an influx of people that were looking and chasing some of these apartments, and they really actually cut that housing potential downfall there from a fundamental standpoint. They actually made it they improved it very quickly because of it. I guess the other thing here, this one's interesting because this is a real page chart here, and Houston was actually impacted by Hurricane Katrina as well, because they had apparently a lot of folks that were living in the New Orleans area, Louisiana, and some of the Gulf, that while the reconstruction was going on for Katrina, they moved to Houston. So even that far away, obviously Louisiana to Texas, you had some significant inflows of people based off of a storm. And so when you think about that, even when you extrapolate that out, yes, we had some issues here in Orlando, but certainly not to the extent that Fort Myers and some of the places on the coast did. And so I expect that we're going to see some of that migration, that short-term migration, while they build, and it could be going as far as as Jacksonville. Certainly Miami is seeing that there. Some of the reporting I read for Miami, I don't have it here. They've tightened up on occupancy as well, as people are just looking for a place to live while things get built. So very interesting. So let's talk a little bit about Ian itself and what we see here. And again, very early, it's kind of hard. All we can do is kind of look at what's happened in other places and sort of kind of put ourselves in that place from an analysis standpoint. And what we see is, again, you're going to have a lot of people that are just going to need a place to stay. And so this is not the time for people to be gouging, renters, trying to squeeze them. They're already feeling squeezed. And I think, I think I know there's rules in place and laws in place to ensure that that's not the case. And in fact, here in Orlando, there's some discussion about some rent control. I don't think it's gonna happen simply because there's state laws that are going to prevent it, but there is this movement, to make sure. And this was pre-Hurricane Ian, so I don't want to tie the two together, but there is some discussions about rent control because of the affordability issue, and this is just going to make it worse. It's just going to be, yes, investors are going to do well. I don't think from a cash flow standpoint, because you do have the higher mortgage payments that you have to keep account for, and higher insurance, that these are going to be over cash flowing deals. But over time, and I think that's the key, in real estate and multifamily, you invest and then you wait. And that's kind of it, right? And it's not supposed to be sexy. It's not supposed to be crazy. It's not Bitcoin. It's not the stock market going up and down. But if you just kind of do that, it's a real asset, and over time it'll increase. And we're going to see that here. It may not cash flow the way that we've had in the past, where you're getting 8-9% cash flow, but we will factor these in correctly to make sure that we're buying right. Prices are starting to come down, and because of that, when mortgage rates, interest rates go down, and we refinance, we're going to reap some significant rewards then. So maybe a little bit of delayed gratification with the cash on cash, but I think overall we're going to continue to see just tremendous opportunities here in Florida, certainly the Central Florida, as it relates to investing in real estate. This is just my bottom line up front again. I think this is the right state. Fundamentals are the right way. And really, Hurricane Ian, all that's going to do is just going to put additional pressure on housing overall. So that means higher occupancy. We are fighting, the Fed. We are, the Fed rates and likely insurance. So maybe the cash on cash won't be as tight as I just mentioned, but overall, still a very strong place to invest. So when we look at, kind of my bottom line is investment makes sense. I still truly believe that, Florida and Central Florida, and maybe even now more Orlando, because it is kind of a little bit more kind of insulated from some of that coastal effect. We're just going to see tremendous growth here as it relates to housing. Affordability needs to be addressed. Insurance needs to be addressed so that, litigation can be tampered down, so people aren't negatively impacting the system by just, from a criminal standpoint, maybe even a fraudulent standpoint, which is what a lot of people seem to think that is going on. But I'm excited about being here in Florida and continuing to invest here. And I don't see that changing anytime soon. It's just, there's too many fundamentals moving in our direction for that to stop.